Hello and welcome everybody to Miles of Fun. I am your host, Kevin Miles, and we're going to be talking a little bit about the Six Flags fourth quarter and 2025 earnings call. And we're going to be kind of talking about what that means for theme park enthusiasts and families that want to attend Six Flags theme parks in 2026. And without further ado, let's get into the nitty gritty of things. We're going to be doing a little bit of analysis of their earnings report, and then we're going to be jumping in and bouncing around a little bit of their earnings call. I'm kind of doing this on the fly. I've actually spent the last couple days sort of listening to this and analyzing it, and I meant to take notes of timestamps, but we've also been doing a lot of out-of-town traveling for some family, so I tried hard to get this a little more streamlined, and it failed. So I'm going back to doing the way I know how to do things, which might be a little clunky for viewers, but hopefully we can iron this out. So let me jump right into the earnings report here. From their own website, let's look at this. The 2025 fourth quarter and full year results. Revenues totaled $650 million, down $37 million or 5% compared with the year before. Net revenues were up 7% compared to 2024, the fourth quarter. So that's so down 37 million compared with fourth quarter on an operating day basis. So there were less operating days. So per day they were up 7%. Attendance is down 13%, or approximately 1.4 million visitors compared with the fourth quarter of the previous year. But again, it was only down 2% per day. Per capita spending, so per person spending, for each person that visited the park, it was up 8% to $66.41 in the fourth quarter of 2024. So more people, so less people, but more of them are spending money. But they still had a net loss of $92 million compared to $264 million the previous year. So their losses are going down. But it's still a company that's losing a lot of money. Let's be honest. And the previous year they had mentioned some pretty alarming things about selling off assets and things, and they kind of touch on that. And we'll get into that a little bit later, but they didn't necessarily come right out and say it. And to be honest, let me go ahead and switch back to my full cam here. To be honest, I think this whole fourth quarter earnings report and earnings call is more notable for what they didn't say than what they did say. And I think we can delve into that as things come. So let's keep going here. Okay, so as the CEO commentary, results fell short of our expectations. The work completed over the past year strengthened the foundation of our enterprise. And I would kind of agree with that. From what I've seen from Six Flags, 2025 started off pretty crazy. It seemed like they couldn't get their stuff together, but I have noticed that there have been significant improvements to the bare bones structure of the company, something that they can build upon, and that he pretty much continues to say that here. Significant investments to improve park infrastructure, new attractions, upgraded technology, enhanced food and beverage offerings. Yep, I agree with all that. Continue to invest heavily in an exciting slate of family-oriented attractions, food and beverage upgrades, record-breaking roller coasters. At the same time, refining their approach to revenue management and marketing, and implementing clear lines of accountability across the organization with a portfolio that includes the most iconic regional theme parks located in some of the largest and fastest growing markets in North America, combined with a sharper focus on execution. We're confident that our efforts will restore profitable growth that is sustainable over time. Equally focused on strengthening the balance sheet. This is the important thing here. Successful refinancing of 2027 notes in early January was the first significant step in that direction, And as performance improves, our intent remains clear: use the cash generating strength of our business combined with a disciplined capital allocation approach to pay down debt and reduce leverage as quickly as possible. Reducing leverage and restoring financial flexibility are essential to creating sustainable shareholder value. Now, what he means by that, if you haven't heard, Six Flags refinanced $1 billion of their debt last month. And basically they're like reissuing a previous loan at twice the interest rate to buy themselves more time. And that's a pretty risky move unless you're expecting some pretty heavy income flow coming up to try to help pay that down. Financial results for the fourth quarter. Operating days totaled 779. 15 days closed due to weather. Compares with 878 operating days in the fourth quarter of the year before. Okay, so we're down almost 100 days across all the parks. 3 days closed due to the weather the year before. A remaining variance reflects 66 fewer operating days due to the elimination of winter holiday events at 4 parks, as well as the impact of normal calendar differences. And again, attendance down, per capita spending up. And this per capita spending up is a good sign. Higher demand for fast lane, higher guest spending, and food, beverage, merchandising. All this is a good sign. That means the people who are still going to the parks are very loyal and spending their money. Operating expenses are down due to seasonal labor costs, operating supplies, and utility costs. But it's offset by higher property taxes and utility costs. Okay. So yeah, overall operating expenses are down, but they made huge labor cuts and operating supplies cuts. And, the parks kind of felt it. At least some of the smaller ones did that I could tell. Let's see, wages, cost of goods sold were down $2 million. Depreciation and amortization, $121 million, an increase of $15 million compared with the fourth quarter of 2024. Impact of purchase price adjustments for legacy Six Flags property and equipment during the fourth quarter. And he'll get into that a little bit in the phone call as well. During the fourth quarter, the company also recognized a $19 million loss on retirement of fixed assets in the normal course of business, including the sunset of the website and mobile assets related to legacy Six Flags. By comparison, the company recognized a $7 million loss of the retirement of fixed assets during the fourth quarter of 2024. So that's comparing 2024 to 2025. So again, if you're not necessarily caring as much about these numbers, and we can go into the balance sheet if you want. There's more below. He kind of talks about, where did it go? Well, let's go ahead and skip from there into the phone call. Why don't we? Let's do this. Here we go. Made that a little too big for this window. Okay, let's do it that way. Okay. I've got the transcript brought up, and we're going to be jumping around. We're not going to be listening to the whole thing. We'll jump around a little bit, but we will listen to sort of the beginning of this and kind of jump around because there are some areas in which I want to listen to in its entirety. So we'll start at the beginning, and I'm going to try up in the corner up here. I'm going to try to bring up the LinkedIn profile of whoever's speaking on the call at any given time. So that way you folks can kind of get an idea who these people are and who's talking. Of course, not everyone actually had a LinkedIn profile, so I've used some other things here. But let's go ahead and get into this here. Okay, we're going to start with Michael Russell at the beginning here.
Call over to John.
Oh, here we go.
Good morning, everyone. My name is Ellie, and I will be your conference operator today. At this time, I would like to welcome everyone to the Six Flags Entertainment Corporation 2025 fourth quarter earnings call. All lines have been placed on mute to prevent any background noise. After the speaker's prepared remarks, there will be a
Oh, come
question and
on.
answer
I
session. If you would like to ask a question during this time, please press
I
star
tried to
followed by
skip
one
forward,
on
but it
your
skipped too
telephone
far
keypad.
forward.
If you would
But
like to withdraw
we're
your
gonna keep going
question,
here.
press the pound key. Thank you. I will now turn the
Here
call
we go.
over to the Six Flags management for opening remarks. Please go ahead.
Good morning, everyone, and thank you for joining us to discuss Six Flags Entertainment Corporation's 2025 fourth quarter and full year results.
And actually, let me go ahead and skip
My
Michael
name
Russell
is Mike.
here.
These statements are subject to risks and uncertainties that could cause actual results to differ materially.
So yeah. Do
Please
not
refer to our
invest
SEC filings
purely
for a
based on
discussion of
this
those
phone
risks.
call.
Joining me
This is
today
not
are
financial
President
advice,
and
by the
Chief
way.
Executive Officer John Riley and Chief Financial Officer Brian Witherow. John will kick things off with his observations of the business since joining the company earlier this morning. John Riley will then take your questions.
There we go. Here's
With that,
John.
I'd like to turn the call over to John.
Thanks, Michael, and good morning, everyone. Thank you for joining us for our fourth quarter earnings call.
Okay, I'm going to skip forward just a little bit because he basically talks about growing up and being in the amusement park business and some of his other jobs.
As the largest regional theme park player in the world.
Mm-hmm.
Second, Six Flags parks are located in some of the largest and fastest growing markets in North America. There are more than 200 million people
Let me go forward
living
here a
higher
bit.
quality food across our parks. Our scale provides us with a clear mandate to constantly improve efficiency. As I've traveled the parks and conducted leadership town halls, I'm encouraged that our park teams are not only embracing the challenge,
Okay, here we are.
but taking pride in driving efficiency. They are committed to do this work.
So this is important. This is the important part here.
The guest experience.
So he
When
before
visiting Kings
okay. So
Island-
one of the things I skipped, he did talk about going to Carowinds and meeting with an executive chef and how they're trying to deliver quality food across the parks. But this is important here. What he's about to say.
Our maintenance team shared their idea how we could save thousands by purchasing certain equipment we're currently renting. I can assure you this is something they are digging into further. During my stop at Canada's Wonderland, Bhavendra, our workforce director, proudly explained how his efforts ensured labor is being scheduled according to forecasted demand levels so that park labor is deployed at the right time and the right place throughout our entire enterprise. Effectiveness in this area helps reduce costs and ultimately helps drive improved guest spending. The workforce management program was deployed across the portfolio last year, and now we stand to benefit from the resources and systems that are in place to drive efficiency and increase reliability in our business.
Okay, so real quick, I'm going to stop that right there. Hopefully this means that some of the labor issues they had last year of rides having to be closed down due to not enough labor being around or entire sections of a park having to be unstaffed. Hopefully those things are fixed with this new labor management system, but I don't know. I don't work for Six Flags. Maybe some of you folks out there who do can shine some light on this new labor management system.
Having been through this process a number of times, I can assure you this: the best ideas and highest return innovations come from the people.
This interests me.
At Six Flags, that's our ride operators, our maintenance teams, food and retail leaders, call center teams, finance and accounting staff, among others. Therefore, we've recently created a formal feedback channel for associates to submit their ideas for innovation at all our parks. So far, we've received more than 300 proposals from our parks alone, recommending projects to create efficiencies and automate workflows. These submissions are currently under evaluation as we look to activate the ideas with the highest paybacks. We want to recognize great ideas, reward them, and scale what works across our entire park portfolio. Everyone should expect a faster operating cadence and higher accountability across the board. We are committed to the operations levers that drive our guest experience in our business. reliability,
So,
cleanliness, value, and fun events and experiences. By mastering these, we will fuel demand and increase guest spending. Moving forward, we will simplify our processes and remain highly disciplined about where we invest to ensure maximum returns.
okay, so I'm going to stop him there. This is something that corporate speak will do quite often is they'll kind of give a nod to the frontline workforce, to the frontline labor force, and basically ensure any employees that might be listening that we're here for you, right? It's sort of corporate speak. However much of it is genuine, that's for the staff of Six Flags to decide, not me. However, later on in this call, he starts talking about automating processes, standardizing processes. He just talked about creating standards, and he's about to mention it again here in the next sentence. The idea that Six Flags is going to be run from employee suggestions, it's sort of lip service in a way. I don't doubt that they have this recommendation project, and I don't doubt that it might create some good ideas that the company might pick up. But this idea that most of the people at the front line are going to be able to make policy, I would seriously doubt that, especially, like I said, if they start automating things, there's going to be less park employees with an opinion to make these kind of suggestions. So we'll see how things go. I kind of like some of the ideas that we're going to hear about later, but let's continue.
For our employees, my commitment to you is to provide clear standards, to remove obstacles to progress, and to make decisions quickly so you can do your best work. For our guests and fans, when you come to our parks, your entertainment experience each visit should meet or exceed your expectations. We want you back, so we plan to earn your trust to ensure that happens. With that, I'll turn it over to Brian to walk through the quarter and full year results in more detail. I'll then share some thoughts on our initial areas of focus. Brian?
Okay, so now we got Brian Witherow.
Thanks, John, and good morning, everyone.
And he's going to get into a bunch of numbers.
Of our fourth quarter and full year results before providing an update on select balance sheet items as well as early performance indicators.
And I'm going to kind of jump here a little bit wherever I can.
Quarter, we are in the
So back to what I was saying earlier about the winter events. Yeah, here we go. In fact, I just got past it. Here, let's do this.
Revenues of $650 million. Two dynamics impacted the quarter. First, results for the quarter were up against a record performance in October of 2024, 2026. And we will rethink the winter holiday strategy with a tighter returns-driven approach, market by market.
See, I went forward 20 seconds and so much happened here.
As was expected, and as we discussed last quarter, a significant portion of the decline in operating days reflects our decision not to operate winter holiday events at 4 parks, a decision that was made earlier in the year. In hindsight, that decision did not optimize profits at every park the way we needed it to. Those events can be meaningful demand drivers, and removing them created a self-inflicted headwind in terms of both attendance and operating leverage.
Okay, so that's important to know. So getting rid of Winterfest and Holiday in the Park at various Six Flags properties, they thought it was going to save them money by not having these parks open in November, December, and parts of January. But having the fewer operating days created less income at these parks and actually created sort of a rippling effect of, hey, if there's no Winterfest, I'm not going to go to the park at all in some cases. For some guests making the decision to purchase a pass or to attend several times throughout the year. So yeah, these were self-inflicted wounds. And here is Six Flags admitting we made this huge mistake. Now, again, whether they're making this admission with any kind of, I mean, But this also comes with, okay, where there were all these weather days too. Well, okay, but you operate a business that's primarily outdoors. You know the weather's going to be a factor. So part of the strategy of being an executive in this kind of business is learning how to mitigate that and learning how to shift operating strategy when weather's bad, or potentially offer more indoor attractions that you can keep open, or more indoor concession stands, things like this, food and beverage options, places where your guests can get out of the weather when rides have to close. I mean, it's a thought, but this is part of the issue with this industry, because a lot of Cedar Fair parks, previously Cedar Fair parks, I noticed a lot of them were removing some sort of indoor type activities in favor of flat rides and family rides over the years, because you can get a more thoroughfare of people on per square foot. So yeah, the indoor offerings weren't as attractive for some of the larger companies back then. I'm talking about 10, 15 years ago. So now here we are, them telling us, well, having entire sections of our park shut down, or in some cases the entire park shut down due to weather events, really damaged our operating leverage here. So hopefully this means we're going to see the parks open for a longer season, open for more days, maybe even open more Thursdays, Fridays, throughout their weekend seasons at some of these parks. And, it sounds like they want to operate more days. Well, hopefully they're willing to spend the money on the labor to do that. All right, so so let me skip forward just a little bit here. Let's see if that's...
eliminate the winter holiday events, which created an attendance headwind of approximately 425,000 visits.
Okay, here we go.
Same time during the quarter, spending by guests visiting our parks was strong. Per capita spending was up year over year, supported by higher guest spending on admissions and on in-park products. That matters because it reinforces that when guests get through the gates, there is clear opportunity to drive revenue and profitability through better execution, including higher throughput, better staffing alignment, efficient food and beverage operations, and overall guest flow.
So what he just said there, those was that 5 things? This is going to be what they're saying they want to do to make money in 2026. They're saying, we realize that if we can get people in the door, they're going to spend money. But in order for them to spend money, we have to execute better. We have to move them through the lines of the rides, the food and beverage, everything they got to do to get through the lines and to the next place where they can spend money. So higher throughput, better staffing alignment. So, they got to have consistency among their experiences with staff, efficient food and beverage operations. Yeah, if you have to wait 20 minutes to get a cheeseburger, you're not going to want to spend more money after that. And then overall guest flow. So yeah, definitely being able to move around the park. Okay, and then he gets back to talking about numbers. Past taught us a lot. Okay, so here we go. Let's move forward about here.
Matters as we strategize our path forward.
Here we go.
Turning briefly to the balance sheet. In early January, we completed a significantly oversubscribed refinancing of our April 2027 notes at attractive rates.
Attractive rates?
Important step in
Those are attractive rates?
And increasing financial flexibility as we focus on execution and performance.
It was double the interest rate from their previous loan. That's all I'm going to say. If it's attractive to them, That's fine. To me, it's scary to refinance debt at a higher rate for anyone. And I would assume Six Flags would be the same. But again, they're talking to their investors. So
Substantial covenant cushion, extended maturities, and a clear deleveraging framework. Our leverage reflects 2025 depressed EBITDA, not structural over-indebtedness. Touching quickly on our longer lead indicators. At year-end, deferred revenues were up approximately 1%, driven primarily by higher advanced sales of single-day tickets and increased deposits.
Okay, I'm going to skip forward a little bit and get back to John here.
Issuing formal guidance. Our internal plans for the season ahead are built.
And I won't pretend to have every answer, but I've spent my career in this industry, and I know what high-performing parks look like. And what I see across this portfolio are very addressable opportunities that can unlock meaningful upside.
Okay, so here we go.
Execution.
So I want to point out one thing here is he says here, I'm early in my tenure and I won't pretend to have every answer. And on the outside looking in, now again, I love Six Flags. I do. I love Six Flags, even though, we'll discuss sort of at the end of this video that things aren't looking good for us Six Flags fans here in Missouri. I'm just going to say that right out. Like, things aren't looking good. So kind of a love-hate relationship to some degree. But I currently love Six Flags and their operations. Things are scary. Things are scary and unpredictable in Missouri right now. So here we go. But this line here, I'm early in my tenure and I won't pretend to have every answer. I feel like there's three things that are glaringly obvious about this entire call / earnings report. And again, it's more about what they're not saying than what they're saying. And this is one of the examples here of, definitely we have this strategy, but again, if something's bad, then we had this winter issue where we were closed more days and we had weather days and all this. So we weren't open as much as we could have been. So that's one excuse for the failures. Another excuse for the failures is, hey, John wasn't in charge through most of that time. He came in toward the end and he's just now making the changes he needs to make. And he still doesn't know the whole entirety of the structure of the business. In fact, several times in here he talks about how he's only visited about half the parks because, frankly, most of the parks weren't open from the time he became CEO till now. So let's continue.
First, we're evaluating how we go to market. We operate powerful regional brands, and we must deploy them with greater precision. Our guests are not identical market to market, and our marketing strategies should not be either. Over the past year, we saw the same promotion produce very different outcomes across regions. This is not a demand problem. It's an opportunity for us to better tailor our efforts to our local communities by applying tighter test and learn discipline. Marketing then becomes a demand lever, not just a traffic driver.
Okay, now, again, I have my personal opinions. I think some of that has to do with consistency. When he says our guests are not identical market to market and our marketing strategy should not be either, and then we saw the same promotion produce very different outcomes across regions. I've seen that with my own eyes. I've seen several people say, hey, we're not used to this being this way or blah, 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 blah. And then they complain and they complain. And then Six Flags changes it again. And so kind of instead of having a consistent message, they're kind of letting the customer dictate the business, so to speak. And so then you're left with the initial customer who was ready for the change, got used to the change, at conflict with the person who was used to the old way and the way things were going to stay the same. And then in the end, you had nobody who was happy. And so this is sort of my message to Six Flags is I wouldn't let this bug you as much as it seems to be bugging you. Is I can kind of tell from the way sort of pricing structure stuff. And it's actually happening literally right now on a lot of public forums with the recent changes to all parks fast pass prices. A lot of people are upset that some regions and some parks got a reduced all park fast pass, and some people love the idea. Other people feel like, well, okay, well now I got to ask for a refund and get a different park's all park fast pass at a cheaper price. And a lot of people are trying to do that, and ultimately that kind of stuff is going to cost Six Flags money, not only in people demanding refunds, but just in the labor that it's going to take to get through all these phone calls and these guest services experiences to process those kinds of refunds, and to answer people's questions who are confused about the structure of the new fast pass pricing. And so this is exactly what I'm seeing here is, our guests are not identical market to market, and our marketing strategy should not be either. I would disagree with that. I think you just need to leave some of your customers a little upset and go with a unified message. I think you need to put out a product where your customers can be a little upset, but they know what to expect, and they know the winds aren't going to change because a bunch of people are upset. Anyway, that's just my opinion, but again, I'm not the one doing multi-billion-dollar business in the theme park industry. It's just, to me, I see the conflicting messages happening in the public forums out there, and everyone's got an opinion. Everyone's going to have an opinion. And at some point, like, John, you're the boss. And at some point, the buck just has to stop, and the changes have to stop, and the customers have to know what to expect. And I think your loyal customers will pay it. And I think ultimately, the people in those communities, in those regions, will eventually wisen up to what's going on. And if the marketing is clear, they'll be willing to pay the prices, I think. One of the issues I saw last year during the Halloween events is a lot of people who weren't used to the Halloween events being an upcharge were very upset that mere park admission did not get them access to the Halloween specific attractions. And sometimes that's just literally having things marketed very clearly. It's kind of like what's industry speak versus what customers pick up on can sometimes be all the difference. And I didn't see a problem necessarily with the upcharge. To me, it was part of the marketing and part of how it was sold. And I think to kick that in September, as opposed to being very clear about it at the beginning of the season, is very telling. And I don't know, some of the language I'm seeing around the Six Flags website smells like they're going to try to do it again this year. I don't know how that's going to work, but we'll see.
Pricing is part of that same reset. Our architecture must be simpler, clearer, easier to communicate across ticket types, passes, and add-ons, with fewer and stronger offers that improve conversion and yield. Better alignment between promotional timing, operating calendars, staffing levels, not simply to produce more demand, but more profitable demand.
Okay, well, he says that. While he's saying that, they just went live with this other sale and with all these pricing changes that just made it more confusing. And again, fewer and stronger offers. Well, now we have, now we have less options. But that's okay.
Second, we're driving consistency of execution and margin expansion. This business rewards operational excellence. A portfolio of our size should benefit from scale, and our guests should experience reliability everywhere. Parks open on time, rides operating consistently, clean park environments, energized teams.
Hey, that makes you excited, right?
To deliver that, we have tightened our operating procedures, established clear standards, define measurable KPIs, and develop protocols for rapid follow-through. A critical lever in this effort is throughput, how efficiently we move guests through every touch point. I've spent time observing where friction occurs: entry gates, parking flow, food service, retail counters, and ride operations. Throughput directly influences guest satisfaction, in-park spending, and improves cost efficiency. Third, we're applying disciplined ROI standards to our business decisions. Every investment must answer a simple question. Does it enhance the guest experience in a way that drives profitable demand, reduces costs, or strengthens free cash flow? And does it do so at returns that justify the investment? That discipline applies to events, rides, and attractions at every level. Our experience with several winter holiday events this past year provided valuable lessons. We will approach seasonal programming with market-specific rigor, clear ROI thresholds, and test and scale methodology.
Okay, so some of this is sort of more money speak, which is what they're supposed to be doing in this call. But we're looking for clues on what this means for us, the customer. And it sounds like, they don't want to spend money to improve the customer experience unless they know it's going to make them more money. Or that could just be what they're telling investors. But, they're in this to make money. Let's be honest. This is a business opportunity for them. They want our money. We want a guest experience. And so they want to make sure that the things they're providing us will provide them with profits. All right, let me skip forward a little bit. Oh, hang on. I want to skip.
Its recovery, deepen guest engagement, and restore durable earnings power.
Right here. Let's do this.
Let me wrap up with these closing thoughts. Our near-term priorities are clear: improving profitability, strengthening the balance sheet, concentrating our time and resources on the assets and initiatives that generate the highest returns.
Okay, that's the scary thing for me. When he says concentrating time and resources on the assets and initiatives that generate the highest returns, this has kind of been some signaling from Six Flags over the past 2 years that, they have some things that are making them money and they have some things that are losing money or maybe not making them as much money. And so they want to kind of focus on some of their bigger parks that's making them more money instead of maybe trying to do what it would take to make the smaller parks make enough money. But that's just my opinion as a guy from Missouri who, his favorite 2 Six Flags parks may be on the chopping block.
Six Flags is a company with unique assets and significant earnings potential. Together, our teams are working to further our progress on elevating the guest experience, realizing the benefits of our incomparable scale to improve efficiency and margins, correcting missteps.
See, and that's like the third time he's mentioned improving margins. Their margin profits were 27%, which was, it's considerably low for any business. If you're only getting 27 cents of every dollar spent at your business because you have to pay all these overhead costs and debt, you're not earning what you could be. And so, your stock's going to tank. And unfortunately, we've seen Six Flags stock take a couple of dips, including a lot of dips that the entire stock market has taken. But we've seen Six Flags do some weird low movement too. All right, so let me get into the Q&A. And I'll start with James Hardiman of Citigroup.
Changing consumer behavior here at play. I think one of the other statements you made is that you think this is a resilient and growing industry, and so maybe you don't think that there is meaningful changes there. But maybe.
Wait, did I go too far here?
you. We are now opening the floor for
Okay,
question
here
and
we go.
answer session. If you'd like to ask a question, please press star followed by one on your telephone keypad. That's star
Sorry
followed by
about that.
one on your telephone keypad.
I'd skip
Your
her, but
first
I'm
question
afraid to
comes
skip
from
him
the
too
line of
far here.
James Hardiman of Citi.
Here
Your
we go.
line is now open.
Hey, good morning. Thanks for taking my questions. And John, certainly welcome aboard. I think in your prepared remarks, I think you said something along the lines of you're not here to spend time in the past. But I wanted to maybe take a minute and just get your thoughts on 2025 in its totality. Maybe do a brief postmortem here in an effort to sort of diagnose some of the problems that you're going to be looking to solve for in 2026. And maybe specifically, and this is a question I get a lot, I'm sure a lot of other people get this question a lot, like how do we put the various issues into buckets, right? Clearly there are some cyclical pressures here.
Weather
Clearly
issues.
there were some weather issues in 2025. I think you guys have spoken to maybe some
Okay,
unforced
so I'm going to
errors along
jump forward here
changing
now that we know what he's talking
consumer
about.
is, meaningful changes there. But maybe help us put some of the issues into these categories so that we can get a better framework for the, business going forward. Thanks.
Yeah, thanks for the question, James. So when we say we're not here to dwell on the past, it
It
doesn't
doesn't
we
mean
aren't
they're not taking
taking the
lessons.
lessons that we've learned from 2025 and correcting missteps and addressing other opportunities as we see them. So, first, if you look at the consumer, we launched products in markets, as we said, that weren't sufficiently localized, and in some markets that produced some abrupt changes as we were integrating. And in those markets, the consumers were used to different messaging. In some cases, they were confused about their benefits on passes, for example. In some cases, they were paying more for a pass than they felt they had paid in the past.
Okay, so I'm going to stop him right there. That's kind of what I was talking about with like the Halloween events. A lot of it is just how you marketed it. Whether they're paying more or not, prices go up. We live in the real world. Sometimes prices go up. Inflation happens. Just like Six Flags has to pay more for the steel to build the roller coasters year over year, guests have to pay a little more for our passes. It happens. We understand. But this idea that we're going to have these bargain basement prices for these passes and we're going to expect them to be all inclusive, that it's going to include everything in the park. Guests should not expect that. And if they are expecting that, then there's a marketing issue. There's a having a clear message issue. I love you, Six Flags, but sometimes it's just literally about putting forth a consistent, clear message to your customer. You are going to pay more. It seems like corporate America is so afraid of telling its customers we have to raise our prices that they will do anything to hide those cost increases. And this is another instance of that. It created such confusion in your customer base that you don't know what to do about it.
And so we're looking at all of those opportunities and then looking to address that misstep. So Brian mentioned on the pass program, we recently, I think 2 weeks ago, launched a regional pass. This is
Shout out to the regional gold passes. That was a smart move.
We're in the very early stages, but we see opportunity here, and we see increased cross visitation. We see people in markets where we have membership moving to membership. So in terms of the consumer, no, we don't think this is a consumer problem. We think we can address this through improving our execution and through addressing some missteps and learning from what was done last year.
And then here we go,
I'd
the
say
margin work.
Performance.
So I'm just going to kind of skip this and just say again, 27% profits. 27% of every dollar they brought in was profits. You can't do business on that, especially when you're this far in debt. Okay. Oh, you know what? I will go ahead and let it play. I'll skip forward a little bit.
Clearly, there are some cyclical pressures here.
Oh, I skipped forward too far.
Your line is now open.
Wait, no, I didn't.
Yeah, thanks for the question. They were paying more for a pass. And then also, I'd say in terms of preparing to execute a number of, so I'll qualify that to say I haven't been everywhere, and we have opportunities like any park chain. But
I went too far again. Here we go.
Trains, up to full capacity as we continue to
there we go, right here.
A number of initiatives there. The other thing I would say about 2025, James, is since joining the company, I've been surprised. I could see the performance from the outside, but since I've joined the company, I've been surprised at the level of foundational work that was done in the integration. So in parks, bringing coaster trains up to full capacity, as we had discussed, improvements in parks, our tech stack, a lot of that work is behind us. So as you look forward at our capital spending, it will be less in terms of IT and technology going forward. We have ERP systems in place.
So basically what he's saying is all the stuff they had to do to merge the company, to create sort of unified policies, to create a unified data systems, to allow the parks to talk to each other's databases and have sort of a unified brand. They've done that now. They don't have to spend the money to do that kind of stuff anymore. So now the kind of expenditures they have to do are going to be on somewhat more direct things than the base infrastructure to get the company to operate as a company.
And then the condition of the parks has been a positive indicator for me. I've been to 14 so far, so I'll qualify that to say I haven't been everywhere, and we have opportunities like any park chain, but it's better than I expected. So I think in terms of the consumer, we don't see any sign there's an issue with the consumer. We think we can address that through our own behavior, through our own plans.
You just got to do a little better job of it. That's all I'm saying.
And then I think that a lot of
I love you, Six Flags,
but in terms of the parks themselves has been laid, which should help us as we go forward.
That's a really good outline.
Okay.
Maybe to the latter point about cost and margin.
We got James again.
Your philosophy as it relates to cost. Obviously, there's a fine line between sort of streamlining the cost structure and impairing the customer experience and by extension the demand of the business along the way. So maybe
this is very important.
Operationalize some of those cost savings at previous stops, and then. Right. Brian, I think we've maybe lost a little bit of the thread in terms of the cost savings.
This should say thread.
Outline. Maybe give us an update. What's been completed? How much is left for 2026? And if there's anything incremental that's been identified. Thanks.
So I'll start over, and then I'll turn it over to Brian James. In terms of
okay, I'm actually going to pause that right there. Okay, wait, no. Let's hear this quote. This is an important quote here.
Between the guest experience and cost savings, I think the thin line you mentioned, I'd say it's a red line. And that's what I've learned in doing this cost work in other chains. You have to protect the guest experience. It has to be a guardrail. Every initiative has to be weighed and measured, and you have to be willing to reverse if you do something that ends up with an unintended consequence.
Again, ultimately, I don't agree with him on philosophy. I don't disagree with him on philosophy. I disagree with him on execution. The reversing something, yeah, you have to reverse, but oftentimes if you just literally pull the rug out from whatever you were trying to do, that could create a worse situation. So you got to be careful how you reverse as well. Okay, so he talks about some basically operations things. He continues to talk about, it costs just as much money to buy equipment as they're spending renting it, blah, blah, blah. And he wants to kind of fix some of that stuff. He talks about, getting back into the seasonal events means you're going to have to store that stuff. So he's talking about storage units. Oh, and then yes, this is where I'm going to go ahead and skip it. But he says automation, parking lots, automated entry at tolls, other things can improve guest experience. So frictionless entry. So great for the customer, great for us. Not so good for people who are relying on these seasonal jobs. Automation kills jobs. It just does. And then again, then it goes back to Brian, basically just talking about trying to make the merger make money, and how much of that progress they've made. He said, we've effectively delivered 100%, but we're not satisfied or stopping there. We're going to continue to look for more meaningful opportunities to offset cost pressures, blah, blah, blah. So they obviously want to make more money. All right, so let me skip forward just a little bit and see where we're at.
Your follow-up, in terms of the, a few of which John just...
Great color. Thank you both, and good luck.
Thanks.
Next question comes from the line of Arpina Kocharian of UBS. Your line is now open.
Okay.
Good morning. Thanks for taking my question.
Arpine Kocharian
John, it is very clear
of UBS.
You know and understand this business well. If you look at the performance for 2025, it was clear to even someone that's not an operator, right, that decremental margin at some of the underperforming parks was very large. So my question is, do you feel like you have a good handle on capturing that this year regardless of demand? In other words, a leaner organization that is more flexible to adapting to demand levels, or do you think it can take some time to get to that leaner organization?
So, corporate speak. She's saying you need a smaller company. Your company's too big. You have too many parts of your company that aren't making money, and basically hinting at essentially the Missouri parks here. So let's hope she's not talking about that, but essentially John goes on here.
Yeah, what I can tell you is that the work is underway to improve the margin, to work on these initiatives that we've mentioned, both in workforce deployment, in efficiency, automation, and in other efficiency and initiatives that we have underway in the company. I don't have a timeline today to get to a specific target. I'm just joining here, but as I said before, 27% gives us a mandate, and I've been quite encouraged by our team members who are embracing that and embracing doing it the right way. So we have to do it the right way. The work is underway. We believe there's considerable opportunity over time. And then the last thing I think that you mentioned in terms of the organization, getting the organization to do that. The what we're doing is important, but I think the why, the how is also very important. We believe strongly in pushing more decisions back with local input to the parks. We believe strongly in simplicity. We need more urgency in the organization.
This is what's confusing to me.
And more accountability, quite frankly. So we're working while...
I'm going to mute him a little bit while you can read the rest of what he's saying there, because I'm going to mute him. Look, a lot of this is confusing because on the one hand he says, yeah, we need a chain-wide structure to some degree, but we also need to allow more regional control and regional input.
It is clear, there are at least maybe 6 to 8 parks that generate less than 5% of EBITDA in this portfolio. At the same time, it seems to me it is not as straightforward to even decide what can be pruned, because there will be underperforming parks that are worth investing in to improve operations, and maybe they're assets that is not quite worthwhile to invest in. How do you think about that?
So again, she's asking about the smaller parks.
Yeah, we approach asset evaluation through a disciplined return framework. We have rigorous work underway on that front in terms of assessing. But our highest ROI parks represent the core of the portfolio, and certainly, as you mentioned, they're done right. This could benefit leverage to optimize the portfolio. But really, one of the opportunities that we're looking at is the strategic focus it gives us in order to be able to dedicate management time, expertise, know-how, capital investments, resource allocation. And I think that has, in the longer term, the potential to be the greater benefit.
And this is where I would disagree with him. Again, I have a lot of hope that Six Flags is a successful company, and I think he's sort of right in that you have to take care of what's making you money. But this idea here that he says that if you look to dedicate management time, expertise, know-how, capital investments, and resource allocation, you don't want to save lost causes. But that's just an assumption that it's a lost cause. And I think if you're throwing money trying to improve what's already almost perfect, then your sort of rate of return on that investment dollar, I don't think is as good as you claim it's going to be by dedicating management expertise, know-how, and capital to places that are already being run well, right? You can't fix what's not broken. You fix what's broken. And yeah, sometimes it's just as simple as there's not enough customers in a market. But other times it's we don't know how to market to these people. And maybe that's what he's admitting to here. Maybe he doesn't know how to market to the smaller markets. I don't know.
Thank you.
Your next question comes from the line of Steve Wieczynski of Stifel. Your line is now open.
Yeah, hey guys, good morning, and John, welcome in. So guess my first question is around guidance or lack of guidance for this year. And Brian, you kind of touched on this in your prepared remarks, but maybe wondering what drove the decision not to kind of give formal guidance, and then maybe from a high level perspective, Brian, if you could give us some color.
Okay, so I'm just gonna stop him there because again, this is one of those, the non-answer is more telling than the answer. And basically, he asks, about the guidance, and then he asks Brian about capital expenditures. So, and then John basically says, yeah, I've only been here 2 months. That's his answer. Like, it's not enough time. 2 months isn't enough time for me to go throwing my weight around telling people what to do. It's a nothing burger of an answer. And then Brian essentially says, we spent $425 million before. We've spent $475 million before. We're expecting to spend $400 to $425 million this year, so it's down. And then interest on the debt's going to be between $135 million and $145 million. So yeah, they need to cut costs. Period. So let me skip forward just a little bit more.
Now is not the time for me to come out with guidance.
I would say that the overall operating days right now are expected to be up slightly, maybe as much as 1%. That could change as we get, further into the year and the opportunity to potentially add back a winter holiday event as an example or two. Those decisions.
So yeah, he's talking about adding more.
$475 million.
Okay, so basically he's saying that operating days are going to be a little bit down because of getting rid of Six Flags America, but that he still expects the total operating days for the entire chain to be up. And then, yeah, so let me skip forward a little.
Yeah, I think it's a good question. So I'd say that the top takeaway I have as I've toured the park.
So he's asking, what are a few things you could identify that the parks could do better? Here's John.
And then as we've, Brian and I and the teams in the parks and in the Park Support Center here, is that the issues are not systemic. The issues are market by
Again, okay, so I'm actually going to skip through this because basically he says, I've been to a bunch of parks and I've seen some stuff in Mexico that I think Mexico could use some extra operating days. And so there we go. All right, let's see.
example. We think in Mexico is a place to lean in, and we're going to.
Your next question comes from the line of Thomas Ye
Thomas
of
Ye,
Morgan Stanley.
Morgan
Your
Stanley.
line is now open.
Thanks. Good morning. I wanted to ask about the particular strength in per caps in 4Q. I know the shoulder season has some mixed factors to it, but can you maybe just talk about the sustainability of that growth? And Brian, I think you mentioned pass uptake improvement, recognizing it's still early in the cycle. Just relative to last year, can you share how units and pricing are pacing on a blended basis, given some of the uptake on the higher priced regional passes?
Yeah, maybe I'll start with the latter, Thomas, and then John can provide some color after that. But
Oh, basically he's going to answer, we just put out the regional pass and it hasn't been out long enough to see. Seeing folks migrate up to higher priced products. And again, not all parks are in operation right now, so yeah, low sample size, and then low sample size with the new pass. Then John chimes in. Solid spending we saw as a sign the revenue engine is intact. Regional path have laid out, but again, they don't want to make predictions based on the new stuff here.
In regards to that average price. Now, yes, continuing to spend inside the park on those in-park products like food and beverage, extra charge, attractions, to name a couple, it's very encouraging. And I think it supports what John said before, which is we don't see a problem with the consumer or the health of the consumer. They are spending when they visit our parks. And, our job is to just continue to
the loss of the events and the mix of parks because of the loss of events. So, as we look at 2026,
So again,
we expect growth.
it goes back to
park spending, but
our customers want to spend money, but we're not giving them enough opportunity to because we're closed for too many days.
Because of that sort of noise in the quarter.
Level for that was an allocation issue, or was it just kind of marketing into a weather situation that was the problem? How would you approach kind of taking that into the new season?
Yeah, so I'd look at a couple of factors when we look at our marketing spending. I would look at number one, the timing of the spend is something that's under evaluation.
So yeah, he's basically asking them, how do you make the decisions about when and where to spend money on marketing, and that's what he's saying here. A couple of we look at our marketing spending, timing of the spend is something that's under evaluation. Power of the return on marketing. We have to look at the quality of creative. So the team's doing a lot of work to address some creative they don't feel was as effective as it should have been in last year. I mean, you got to be consistent with the message.
Creative that they don't feel was as effective as it should have been in last year. And then finally, in terms of our marketing spend, just more at a general sense, we have to look at our mix of awareness versus conversion spend.
Boom.
And
boom.
One of the really great things about these parks is we have very high unaided awareness in our markets, but we're doing a lot of awareness marketing, and we think there's an opportunity to move more of our spend into dedicated conversion. So those are just three more general factors, if it helps, that are some of the work underway.
Okay, so I'm going to prepare you. This next question from Truist Securities is going to be very important to me, and they're not going to answer it.
Yeah, very helpful. Thank you.
Next question comes from the line of Adam Fox of Truist Securities. Your line is now open.
Yeah, hey, good morning. This is Adam on for Patrick Scholes. Just wondering if there's anything, going back to the park optimization efforts, if there's anything you can share about Enchanted Park Holdings in particular. Thanks.
Yeah, Adam, we don't have anything to share today on that front.
Okay. So someone came right out and asked it. What's the deal with Enchanted Parks? And if you folks aren't familiar, there was an LLC that was filed about 3 weeks ago. And after the LLC was filed for this new company called Enchanted Parks LLC, there were 9 trademarks filed. One for Enchanted Parks, and then a water park, and five trademarks that were filed that seem to be tied to properties in the Six Flags portfolio. And a lot of people are saying, well, this is a clear sign that these parks are being packaged together for a sale. And this Enchanted Parks Holdings is tied to a company called Innovative Attractions Management out of Orlando, who own some amusement parks of their own, but also have stated that they want to acquire more and that they really want to get into the water park business as well. And I think that might be what we're seeing here. I want to put forth that we don't know what this means. This could simply, this is just a trademark filing. We don't know what this means for Six Flags. This could be a nothing burger, but with the kind of language we've been hearing in this call, followed by Six Flags just flat out not answering the question. They don't want to reveal their hand. They don't want to mess up whatever deal they got working on behind the scenes, or lack of a deal for that matter. They may just simply not want a crazy rumor to affect their bottom line with ticket sales. We don't know why they won't answer the question, but they won't answer the question. And to me, as a customer, I would prefer the businesses the businesses I purchase from to be a little more upfront and honest. I can understand why they're not. PR is a crazy thing, and especially when he's talking about putting out the right marketing message. You got to get this right. I with all the rumors that were circling around Six Flags America before they decided to pull the trigger on that situation, with the destruction of the King Dakar roller coaster and all of the sort of weird press that got, and some of the denial and refusals to answer questions, and Six Flags, and before the merger of Cedar Fair, kind of hush hush on pulling the trigger about removing things from their portfolio, but with good reason. But also, you as a customer, you kind of wish you had more information. Wish you could make a more educated guess into what's going to happen in the future, because, for a person like me who does a lot of state to state travel, it would be helpful to know, like the All Parks Pass I bought this year. If I buy the same product next year, am I going to get the same value out of that product next year? Or should I travel more this year? Should maybe I check out Galveston? Should I check out Michigan's Adventure? Should I check out Six Flags St. Louis while I have that in my All Parks Pass? I could see why Six Flags may not want you to visit those with this year's pass, because they want you to visit the parks that will make them more money in the long term. But again, hopefully Six Flags don't care as long as we're spending money at a Six Flags park, but we don't know. It seems like they would rather us spend our money at Great America or over Texas or Cedar Point or Magic Mountain. Those seem to be the big four. They really want us to spend money at those four. But we'll see. One last question from Anthony Burney. And he's
Okay,
basically
thank
going to
you.
ask about capital expenditures. I think we can.
Thank you.
Thank you. Our last question for today comes from the line of Anthony Burney of Jefferies. Your line is now open.
Hey, good morning. This is Anthony on for David Katz. Thanks for taking our questions. The first one is, can you talk a little bit about your capital allocation priorities? How should we weigh deleveraging versus CapEx spend? And on CapEx, can you provide any ROIC targets that you have for that spending?
This is John. I'll start out.
I'll actually just pause that there because he mentioned deleveraging, and I'm trying to see weighted average priority. Growing business to the right level. Beyond that, funnel excess free cash flow first toward paying down the debt. Okay. So again, a lot of this stuff's important for investors to know, but not so much more us customers. Accounting noise related to price adjustments in some of the legacy Six Flag parks. Accounting change related to Cedar Flag. Okay. Well, we'll call that. But what do you folks think? We'll call it there. What do you folks think? Do you think outlook is good for Six Flags in Missouri for 2026? If you've purchased an all parks pass, are you looking forward to the experiences of Six Flags parks in 2026? Leave me a message down in the comments below. This has been well over an hour now. Hopefully this isn't going to be too much to get into YouTube algorithms. Look, I admit I'm a fanboy. I love these parks, especially the two Missouri parks, and this necessarily wasn't a good sign for the Missouri parks. And it wasn't really a good sign that they know how to fix the problems going forward. But it's very encouraging that at least they're willing to try. I think that's one of the big messages. At least they're willing to try. You see a lot of these big corporations that are unwilling to just say, hey, we messed up and we want to do better. And I do feel like this is kind of Six Flags management not only replacing their CEO recently, but then having to come to their investors repeatedly with a loss and say, hey, yeah, we messed up. Now, again, I think the excuses of, well, we had weather days, and yeah, we fucked up, but only in as much as we didn't do holiday events. And, well, we would kind of know how to fix things, but John hasn't been here long enough to give us his opinion on those things. Those aren't necessarily messages that breed confidence to the consumer or the investor. And unfortunately, I'm sure a lot of those investors wanted to hear, okay, well, which parks are you selling? Which parks are you shutting down? Where can we stop spending money so that then we could take that money and funnel it toward paying down our debts and therefore having bigger margins and bigger profits for these investors? That's what the investors wanted to hear. They wanted to hear, what are you going to do to make us more money? So it's the job of John and Brian and Michael, to some degree, to walk this tightrope of not saying anything that would piss off your customers or piss off your investors, even when it seems the interests of your investors and your customers may not be on the exact same page. And so, again, I'm not a corporate CEO. I'm not in that kind of a business. I'm not saying I would do better. I'm just saying I hope they can do better. And I hope that their version of doing better isn't to gut the company. Especially as a fan in Missouri, I hope the answer isn't to gut their Missouri properties. And if they do, I hope they do their due diligence and sell it to somebody who will give a crap. I don't want to see what happened to Six Flags America happen to another regional park. Just on a very personal side, I really appreciate small regional amusement parks, especially independent ones, but I'm not a big fan of Disney. I'm not a big fan of Universal. And I've been to Cedar Point. I enjoyed myself at Cedar Point, but not nearly as much as I've enjoyed places like Valley Fair, Carowinds, Holiday World, Silver Dollar City. Those parks really make guest experience more important than churning the human experience through a big line. And, you know, I'm definitely hoping that they've realized that balance to some degree and that they're willing to make those improvements at the smaller parks, but it's not real hopeful. But only time will tell. You know, again, this is probably the first real message we've gotten from Six Flags on what their 2026 plans are outside of the sales of season pass structure, right? Anyway, let me know what you folks think. Leave me down a comment down in the comments below. Go ahead and click that like, subscribe, all those buttons. Please help me. This is a very new channel. This is pretty much my first video after my welcome video. And again, maybe I don't know what the fuck I'm talking about, but it is what it is. Pardon my language. Trying to get better at that. But stick with me. We'll be talking more about fun theme park stuff and not so much about the business end of things in the future, but I definitely wanted to do a video on this and what it means for the 2026. So hang in there, folks. Till next time, keep your hands, feet, personal belongings inside the ride at all times, and have a wonderful day.